Here we go. We are in the home stretch of 2022, and I can say that just about every sector in finance is looking forward to getting 2022 behind us. This is your December real estate and financial update for the US and Metro Detroit markets, and let's do this. As always, hit the like button so more people can see this video and the subscribe button to stay in the loop. We create local content about Metro Detroit and Ann Arbor and post new videos every single week. If you're looking for a home or want to know how to get the most out of your home with the least amount of hassle, call me anytime with the number on the screen or shoot me an email on the screen. All right, let's start with the jobs report. There were 261,000 jobs added in October as reported in November, despite the looming recessions and recent layoff. More on the layoffs in just a minute. That was about in line with expectations. Gone are the months of month after month, 400, 500, 600, and sometimes 700,000 jobs added to the economy or even more. The unemployment rate ticked up to 3.7% from 3.6. Now, I want to be sure to note that recent layoffs by big tech are not included in this report. So I'm expecting the November report to be just a little more dicey that we're going to see here shortly. Let's go through those. From least to most, these companies have laid people off heading into November. Robinhood has laid off 31% of their staff, Tesla 10% of salaried employees, Netflix 450 people, Shopify 1,000 people, Stripe 1,100 people, Coinbase 1,100 people, Twitter 3,700 people and counting, that number's growing, and Amazon 10,000 people, which is really unique and unusual for them, especially heading into the holiday season. They usually add jobs, they don't eliminate jobs. And of course, Meta has laid off 1,000 people. That's made some big news lately, and Apple has frozen hiring indefinitely. But there is a silver lining here. These sectors added jobs. Healthcare, 53,000 jobs added. Technical and professional services, because of course we always need more accountants, right? Added 43,000 jobs, and I'm sorry for any accountants watching. Manufacturing added 32,000 jobs. Leisure and hospitality, which is essentially restaurant workers and hotel workers, 35,000 jobs added. While tech is getting hit hard in Michigan, we're fortunate not to be as tied to it as other states, and more tied to healthcare and manufacturing, and that's a pro for Michigan. Stay to the end to find out what all these pros and cons mean specifically for our market. Continuing down that path, inflation has finally eased a bit to 7.7%. I really wanted to see a number that started with a 6 for a lot of different reasons, but I'll take a 7 over an 8. Now here's what this means. Although gas and used cars have come down in price, soaring cost of living and food have kept the inflation rate super high. Here's what this means going into the future. We have another 5th large rate hike coming in December. This time, I don't believe Jerome Powell is going to raise it 0.75 like he has in the past. I truly believe he's going to settle for a more modest 0.5 to try to skirt a recession, but not bring us into a full-on recession. And I think he's looking at the same data that we are. Some pricing is easing, like gas came down another 10 cents a gallon, used cars as mentioned, but real estate and rents have started coming down as well, and usually that takes about 90 days to 6 months to show up in the CPI report. But trust your local real estate expert, I can tell you it is there, and we're going to dig into that in a bit. But first, stocks. Q3 earnings reports are in and next quarter targets are set. There's a myth in finance, and you can Google it, it's called the October effect. There's a myth that stocks fall during October, and it has been less true than October 2022. Actually, since 1928, the stock market has risen about 0.5% on average, taking in all of the Octobers over the last 94 years and averaging them together. It should be called What the Heck is Going on September? Because during September, even in the best of markets, the stock market is usually down 1% on average. This year it fell 9% during September. And I think people see this in October when they look at their statements and figure it's a bad October when it's really September. This year, the markets went up a tremendous 14%. That's the best October we've had since 1976 per Kiplinger. Looking at the historical falls and climbs, and now listen to this part, economists are predicting there's an 82% chance the market will be up over the next 90 days and a 73% chance that the losses that we've incurred will be completely erased in as little as 18 months. Now, what does this all mean? My friends, if you follow the advice I consistently give on this channel, it's like the cover of the Hitchhiker's Guide to the Galaxy. Don't panic. And always have a towel. Very useful things. And I digress. For most of us, we're not inside a decade of retirement, so monetary losses and momentary losses are always followed by growth. In 2008, the stock market, the S&P 500, specifically lost almost half of its value. Half of its value, but it regained it all by the end of 2011. Not every company and not every mutual fund, but the total market value had been completely gained back by the end of 2011. So if you're looking at a 2-year time horizon for pulling 100% of your money out of the market, which is no one, if you're not looking at that, we're good. even using the 4% rule, which I'm preparing a video on right now to go over the nuts and bolts of that one, if it's still a thing or not a thing, so subscribe to be notified when that one. But using the 4% rule should help calm nerves because you're only pulling out 4% of your total assets per year to use for your day-to-day expenses. To help with that, the first 10 people that like and comment on this video and subscribe to the channel, that email me that they liked and commented and subscribed on this video, I will send a copy of The Psychology of Money by Morgan Housel straight to them. It's a great read and I love giving this book away. I hope you enjoy it as much as I do. Now, let's talk about crypto winter. The next in a long line of companies to fall is the $60 billion behemoth FTX. Well, they were worth $60 billion a few days ago, and today they are worth roughly zero. In a very candid interview with Vox, which is almost comical, I'll link that below, he says, no one really wants crypto regulation. The owners of these companies say it because it's good PR. I won't get too into FTX in this video. I think that's been covered enough in the news, but suffice it to say, crypto winter is far from over. After going mainstream and spiking at the start of the pandemic, most crypto coins are down between 55 and 98% off their peak and still falling. As always, I advise in anything unregulated, be careful, don't invest too much. Like 1% of someone's total net worth is too much to me as far as crypto goes, and that's just my opinion. Money has a unique equation that has stood the test of time. Money equals time. So the quick returns and the get rich quick of the crypto, while it was very alluring, I do not believe is sustainable, and that's proving out to be true during this crypto winter. Now, there are a few companies that have spiked, and every once in a while, a blind nut will find a squirrel, but for us normal everyday folk, periodic deposits over time, invest and don't touch it ever in history of ever. Follow this Facebook or Insta page. It's actually called Personal Finance. This guy is super good and very calming. It's not sexy or flashy, but there it is. And most millionaires aren't either. Actually, I'll give you a choice. If you're one of the top 10, pick from The Psychology of Money or The Millionaire Next Door. He does a great job in that book going through what the profile of the millionaire next door really is. Next up, let's talk credit cards and home defaults. Two things that could be not more opposite, but have a very significant relationship with each other. From a 30-year low in 2020, Americans' credit card debt in Q3 2021 to Q3 2022 has risen 15%, or $121 billion. Typically, this precedes a run-up in equity-out refinances, where people refinance their home and pull money out to pay off their credit cards. But with interest rates spiking, I took a look in another direction because I just haven't seen the refinances spike, and my suspicion was correct. The number of home equity lines of credit given in 2022 to homeowners is at its highest level since 2007. Now, these still have high interest rates in the middle 6s or even low 7 range, but they allow owners to take equity out without losing their coveted 2, 3, or 4% interest rate on their main mortgage. Sure enough, those are up 44% year over year. In fact, nationally, the number of owners with HELOCs have grown from 12% to 16%. So 16% of all homes have home equity line of credits on them, and that number is growing. This is a number I'm very afraid of. So far, the single biggest protection of the real estate market have been the golden handcuffs of low interest rates paired with high equity. And here's what I mean. People that have a 2, 3, or 4% interest rate don't want to lose it. And in fact, the usual life cycle things that happen like promotions, marriage, children, divorce, and death are still happening, but people are trying not to upsize or downsize to hold on to that rate. And that should be a good thing because millennials and baby boomers are the two biggest generations. Millennial homeowners don't want to move up because of rates, so they're living below their means, which is good, and baby boomers don't want to move down because they're living longer and too have great rates or paid off homes. Until this moment, I truly believe that this would save the real estate market. Then comes the HELOCs. People are tapping equity at an unprecedented rate to pay off credit cards without changing their spending habits. And here's an example. Right now, 85% of US households have 4 streaming services or more, and I mean 4. The most common mix is Netflix, Disney, Hulu, and then either Apple or HBO. The average cost of these 4 is $55 a month. Just over 40% of Americans go to a coffee place like a Starbucks or a Dunkin' or a local shop 5 times a week or more, costing an average of $80 per month. Instead of curbing our spending habits like cutting 2 streaming services or cutting back to once a week, saving $80 a month between both the streaming services and the coffee, Americans are simply swiping the card, and when the balance gets too high, we're using our house as the credit card, just like 2004, 5, 6, and 7. I'm gonna tell you, my Folgers is about 40 cents a 12-ounce cup, and that is just fine. And yes, I totally outed myself that I drink cheap, really bad coffee, and that's okay. We know what we have to do as Americans. Tighten that belt just a little bit, and then a little bit more, and think before we Starbucks it, stream it, or Amazon it. And in fact, the single most cost-saving measure that I've taken for my household in 2022 is taking the Amazon app off my phone, forcing myself to use a computer, increasing the hassle factor, and buying much less. Rents. Let's talk rents. There's finally a break in the rising rents. Rents rose at their lowest pace over the last 30 days than any other time in the last 18 months. Rents still grew at 4.7% month over month, and that sounds high, but let's put it in perspective. A rental at $1,500 a month a year ago would be about $1,575 a month when released, but it's a lot lower than the 10 to 15% gains we have been seeing. Over the last 18 months, the majority of leases have already reset, and from the start of 2020 to now, total rents are up over 30% in Metro Detroit. A recent survey of tenants by Realtor.com is showing that 69.5% of renters are intending not to release the same apartment or home, opting to find something cheaper, which is going to be hard to do in this market because rental new construction has not kept pace with the needs. This is also why when we drive by places like the Griffin and Royal Oak, the towns at the corner where the old Tiger Stadium used to be, and Innova and Novi, they are not in fact condos for sale, although they look like they are. They are dozens of developments that are apartments for rent. Rents are high enough to be worth building new developments for, finally. Real estate. Finally, let's talk about it. Nationally, home sales are down year over year. In 2021, we ended the year with an eye-popping 6.3 million homes sold, and this year it will drop to 5.2 million projected, and we're close enough to the end of the year to project. Now, the good thing is the number of homes for sale has not spiked and not risen like they did in 2007, 8, or 9. So we haven't seen prices go down, in fact, quite the opposite, and we haven't seen very much equity lost, if any, even if the multiple offer situations are largely gone. Also, nationally, areas like Silicon Valley, San Francisco, and Austin are starting to struggle because the majority of recent layoffs related to tech. Other areas like Boise, Phoenix, and Fort Lauderdale have started to struggle because of a pullback of their biggest pools of buyers, the institutional investors like Open Door and BlackRock. And that's where we in Metro Detroit lucked out by being the last kid to be picked. Open Door just got to Michigan this year, Metro Detroit and Grand Rapids namely, and BlackRock isn't even investing in the Midwest right now. So some of the run-ups that were worse than here are falling harder and faster, back to Boise, but that doesn't mean that all is clear skies, just that we're having and will continue to have less turbulence than other areas. Interest rates. They ticked down about a half a point to about 6.5% off their peak 7.25%, and that's the lowest we're probably going to see for a while. There's also the 2-1 and the 3-2-1 loans to get interest rates down at least temporarily into the high 3s and low 4s until this thing abates in 2023 and interest rates start coming down as a whole. Call me to get some more details on that. Numbers on the screen. Here in Metro Detroit, we've seen the number of home sales drop over 26% from their peak this spring. Oakland County saw the heaviest hit in sales at 30.7%, followed by Washtenaw County at 29.2%, Livingston County at 28.9%, Wayne County at 24.3%, and Macomb County at 23.2%. Our East Side friends are still buying homes. That only tells a part of the story though. The median home sales price is still rising, up 4.4% in the last 30 days, because the number of active homes on the market continues to move up, but very, very slowly. And in one county, it's actually down. In the total metro area, the number of homes on the market is up 7%. Not a ton, not the 30 or 40% that we're thinking, just 7%. In Oakland County, the number of homes on the market is actually down 6.9%. And I can attest to that. I'm still looking for a home myself, and they've been slow to come to market where I'm looking. Overall, the median home sales price again is up 4.4%, with Livingston County winning that race at 7.8% up. And the average days on market is up overall 14% to just over 20 days on market. Still only 19 days. Still makes it a great market. Now, Macomb County has had the highest jump for times on market, increasing 33%, and Livingston County is actually coming down 3.4%. So in Macomb County, we're seeing 23 to 25 days on market as the average, and Livingston County actually dropped down to 16 days on market as the average. Now let's take a look a little more micro at a little more numbers in the metro area. Over the last week, just over 1,800 homes and condos accepted offers, and just over 2,000 sold and closed. Also, price reductions are happening. There have been just over 2,000 price reductions over the last 7 days. What does this mean? This means that pricing in Metro Detroit is still holding strong because the number of homes is not spiking like other parts of the country, thankfully. And I sifted through the price reductions, and for the most part, it's home sellers that are starting above where other homes in their neighborhood or area have sold, and then they're moving down over time into the sales range of home sales in the last 90 days. It's not yet an indicator that home values are coming down, just that they're not going up as dramatically as they did in 19, 20, and 21. I still believe, based on all the data, some of the metros are going to be hit upwards of 15 or 20% as far as home value drops. But here in Metro Detroit, because of our non-tech based economy, stable population, and lack of institutional investors, we're going to see prices fall, but it will be closer to a 5 or a 10% decrease, area dependent, before this is done. Much better than other areas. So this is your December 2022 slide into the end of the year finance and economic update for the national news and here in Metro Detroit for real estate. My name is Mike Perna. I'd be honored to be chosen as your realtor of choice. Should you be buying or selling, call us anytime, email us anytime, and make it a great day.